Admit who's here.
What up, brother?
Hey, what's up, man? How you doing today?
Good, man. Dealing with this monster right here.
Hey, man. Hey, what's up? I also see Troy. Let me see. Troy don't have it. So let's see. Joining. Got a few other people coming in. More. Come on in. Good. Hey, it's 10:30. So, hey, what's up, Troy? How you doing, my friend?
Good, brother, and you?
Great. And we'll have more people. Chiming in, but it's 10:30, so I like to get started on time. So thank you guys for doing that. I appreciate it. As people come on board, I'll make sure to be mindful of that. But I'm going to mute everybody. But if you guys have questions, for now I won't mute everybody. But if it starts to get a little bit noisy and it starts to cut in and out, I will do that. So good. Well, first off, I want to thank you guys for coming. You guys know me already. This is kind of a family and friends thing, for whether they're investors or people that have questions about what I'm doing, wanted to do certain things with me at any point. So that's good. So if you guys have questions, feel free to ask. Like I don't mind. And we won't go past 11 unless you guys have a ton of questions, which we can jump offline and I can answer all of your questions. So first off, for you guys that don't know me, there's a few people on here that do, and I think we have all of you that I need an administrator. Hey Bob, how's it going? I'm going to mute everybody real fast because as we start to get going, mute everybody, mute all other than myself. We'll go from there. So, first off, I just kind of wanted to thank you guys for getting on, but I definitely want to go over the disclaimer because my attorney says I have to. So we're going to be kind of, this is for educational purposes only. I do have a fund open. You guys are welcome to ask any questions that you have. You can sign up to be a part of that fund if you want to invest in that fund and go over the things that we're going over. Take 5 minutes with me to answer any questions, go over the documentation that we have in our investor portal. That is invest.bell-capital.com. You can go there, register, set up your investment account, and you can see all the documentation, and I can go through that with you, and you can do your own due diligence. So the next one is my own personal disclaimer. This is a common sense thing. Any investment involves some type of, you can lose all your money. You're a big boy. We're all in this thing, big boys and big girls. We're in this to make money. But the reality of this is that, any investment advice, always go across and ask your professional counsel and advisors about what you should or shouldn't do. Do your own due diligence. That's a smart thing to do. Again, this is not an offer to sell you guys securities, but I want to educate you guys on what I'm doing and how you can get involved if you choose to. Boom, there's my disclaimer. But the big net, you can lose your money. Like that's the net. Everyone should know that. So first off, a little background about myself, so you guys know. If you haven't met me, or if you're on here, you got referred to somebody by somebody. I'm Victor Bell. Let me see who's waiting. Admit, good. So I'm Victor Bell, and my background is I've actually been doing real estate for about 20 years or so. I've been involved in about $65 million worth of real estate deals with myself, partners and stuff, but that's me. I'm not a broker. I'm not a real estate agent. I'm not any of that stuff. I'm just a guy that put his head down and worked because I believe in real estate and what it can do for me. And it's never let me down. I'll be honest with you about that. So that's first and foremost. Let's see, admit. So that's it first and foremost about myself and my background and my 20-year career in investing in real estate and having done $65 million worth of deals. Unlike other people who claim they've never made any mistakes, I have made a lot of mistakes. I've lost a lot of capital and I've always made that money back. Hey, David, it's great to see you. I've always made that capital back, but there's one thing that's remained a constant. The majority of my money has always been done. I've had like 3 or 4 different companies. All of the over money that I make, I put a lot of energy in all my companies. Every one of them I care dearly about. But every time I have any extra money and or capital that I've made from other companies, I've always put it back in my real estate company. That is where the bulk of my money is. And that is how I've always created wealth and freedom for myself. So, and it's not to sell you guys on freedom. You guys are investors. You guys are business owners and entrepreneurs. You understand that. So, without further ado, I just kind of wanted to go through that and kind of go over why I chose this asset class of apartment complexes. I chose this asset class of apartment. Basically, I call them apartments. So I'll lay off the fancy words. As it relates to apartments, why I'm doing this now, why it's important to me now is the number one reason is housing. Because I'm watching what's happening out there and I'm recognizing the differences in between the fact that there is enough houses out there, but there's not enough affordable housing, affordable rents. I'm not talking about low income. I'm talking about something that makes sense. So when I take a look at what's really happening out there, right now, incomes are flat. Housing itself is expensive if you look around at what's happening in the market for real estate, right? Jobs are moving around. Jobs don't have to stay in one place anymore, especially after the pandemic. We can see how everybody's kind of doing this. Like, I would rather be in person with you guys so I can shake hands and rub bellies and have a good time. But the reality of this is this has changed how things will always be done. So if you take a look at your own marketplace, the number one thing that you hear is there's not enough either affordable places to live and rent. Housing is really expensive. And the big fear is, will I be priced out of the market? And when we look at who that is, it's younger people, the millennials, and or people who are getting a little bit older who don't need that big place anymore, right? So where are they moving to? Rentals, homes. That's why I chose as the vehicle that I know that I'm going to put all of my money into through my own investing and my own funds, as well as dealing with other people who are interested in investing. It's going to be in apartments, and it's going to be a long-term play for me. So, I had these very simple principles that I wanted to kind of go over with you guys. Is this good for you guys? Can you guys hear me okay? Am I yelling at you? No? Let me yell at you, man. Let me get this down. So I'm gonna scoot back some because I usually stand up. If you guys, I usually sweat because I'm a sweater. I like to run around. So this is awesome for me. So the 6 reasons I think personally that apartments are as a great investment is number one, is capital preservation. That's our number one priority as it relates to investing. Don't lose money. As a man who's been hammered through 3 different market cycles, I always saw the consistency of everybody. Every time I did a great deal, I did not lose money on that thing. So that is number one investment priority for us. You've heard Warren Buffett say it, Steven Schwartzman say it from Blackstone. Every one of them have one principle that's consistent is don't lose money. All right, number 2, the reason why we love apartment buildings is cash flow. They cash flow. I'm not looking for anything that doesn't cash flow. For example, this is just a club. Can you guys see that? I gotta move this over. Oh. This is the clubhouse from one of the deals that we were in the running on. Now, that deal, unfortunately, we came in, we didn't get the deal. Another group beat us out on that. This is another deal that we were working on. All right, can you guys see that? That's a 100 unit. I mean, that's a 100 unit deal. This one is actually a deal that we are kind of going back and forth with the broker on right now. So that's a deal. That's 157 units because of some clubhouse piece. But this one actually just traded. We were also in the running for this. And I'm showing you these deals because everyone likes to show you the deals they close, but nobody wants to show you the deals that they're focusing on. Maybe they missed them. I go to bat for a lot of properties. I do. And a lot of people like, oh, I got this deal. Like, what didn't you get? What is the consistency of the caliber of the properties you're looking at? This one right here, I showed this one last time. This one is a 179 unit. It's a brand new complex. It was built by a builder. They came to market with just specific groups. I just happen to have an inroad with some great brokers and other investors that are boots on the ground for me that bring me deals that most people wouldn't even know. You wouldn't know about this deal if you were just an average investor at all. They won't even call you. So that's the difference of what I'm talking about as it relates by being in the real estate game with apartment buildings and having a consistency with the type of product that you're looking for. So the next thing, and I talked about that with cash flow. These deals cash flow already. They're full. They're nice. We're not going in and tearing stuff down to the studs. When I'm looking at a deal, if that's happening, I'm actually not interested because what's my number one rule? Don't lose money. I'm not interested in those type of deals. I believe that over time, those deals will lose money. There's a gamble going on. And for that, I'm not interested in that at this frame, especially when I have investors right now, right? So the next thing is appreciation. Do you think over time, this deal with the pool itself, they probably spent about $1.5 million on just the swimming pool. Do you think that over time somebody will come along? I think we're in around hold on. So hey, what's up, Will? So I think for this deal right here by itself, $1.5 million swimming pool, 178 units, brand new property being sold by a builder. Rents are about $200 below market because they started coming on board. Do you think that at some point, let's just say, and just for argument's sake right now, because I won't go over the pricing, but let's say that's a $100 million transaction. We have to put up 40%. Let's say we went into that deal and we had to raise $40 million. This is hypothetical. Walk down the line with me. Do you think that at some point, if we bought it for 100 over the next 10 years, somebody that has capital, a big group like Blackstone or any other of these family offices that are buying properties like this, do you think that they will come along and offer us $140 million for that deal over the next 10 years? Yeah. Could you assume that? All right. And this is based off rents because we know for a fact that the rents on this thing could be raised. We don't have to go in and fix it. This is a prime location near hospitals, great schools, right down the street from Whole Foods, Starbucks, where there's discretionary income in that area. Those are the type of properties we're looking at. Now, on this deal, will we get it? You know, I'm going to have to raise it, but we've already sized the loan, so I know it's a functional deal. So the next thing, which brings me to my fourth piece, is leverage. This is why I believe apartment buildings are probably the next great play because the amount of leverage that could be put on them. As it relates to debt, and the debt side, the capital markets are willing to play in the multifamily space because if you can't get a loan for the property, that's a problem. And as the market right now has changed, cap rates have lowered. As cap rates come down, quality must come up. Do you guys get that? So as you're looking at any real estate, as it relates to the returns that you're going to get, as your returns come down, your quality has to come up, right? That's the new game that has to be played. And I think if somebody's not going to be doing that for a long time, they're going to have a tough time because one, they can't get the debt, right? They're going to have to put more money down. It's going to lower their returns. And now they're going to have a less than quality asset that they can't get out of. That is how you lose money. I promise you, every time. So number 5 reason we love apartment buildings is the tax havens. Hey, you know what? When you can roll capital from like, let's say, for example, I'm going to show you on my phone, right? So we'll just use 100 units, all right? So if we have, and if you guys have your phones, basic calculator, all right? So if you have 100 units and you're able to raise the rents $100, right? That's $20,000 for the year. I mean, for the month times 12 months because everything's calculated. That's $240,000 of additional income that you created just by raising the rents $200. Now, I've raised rents $200 getting a property, just being the new owner. I went in, I was like, hey guys, I'm new. Your rent's coming. I mean, your lease is up. It's going to be a $200 rent raise. I just wanted to give you a heads up. That'll start in 60 days. Do you want that? And in exchange for that, I'll do X in the unit, right? Typically, it wasn't much. They were able to do that. Now, let's say, because I'm conservative, I'm not able to capture all of that. I'll say, well, let's say we only get 5% of that. That brings us down to $280,000 additional income per year. Divided by a market cap rate, I usually use 0.05. That's an additional $5 million of additional value that we've created literally from just going in and taking care of the tenants. Good tenants in great places that want to live there. Now, do you think if you lived in a place like this, at least with the common area, just a swimming pool, right? We'll use the other one. We'll use the one I missed. I love this deal. I love this deal. I'm going to buy this deal. Just because the last guy bought it doesn't mean I won't go back and get it at some point. Just knowing that there's a property like that, do you think you would move out because you know that you can? There's not a lot of affordable rents. Now, let me say this: the rent on this place is $1,700 a month. That's it for a 2-bedroom. Around houses that are currently selling for $800,000 to $900,000 in a gated community around it. I'm not looking at trash anymore. Like that day is gone. I'm not going to invest any money in anything like that. So the tax haven of being able to take a property that I showed you guys, ultimately, we've been able to create an additional $5 million, let's say within the first 2 years, all right, to just go in, take care of the tenants, talk to the tenants as leases come up or they're not up. We're able to do that. We're able to capture, right, that capital, whether we're going to turn around and refinance that money and roll it into something else, which is a tax haven, or we're going to sell the property at some point 5-7 years down the road. You know, that's at $200. Typically, I'm looking for a $400 bump over 7 years. and naturally that would have been double. Let's just say that would have been double. That's another $10 million. If we would have even sold that property, we would have 1031 into another property like that. That $10 million extra naturally becomes for us. And the last but not least, apartments is scale. You know, the difference of what I used to do before was look for 10 units, 20 unit buildings. And my thought process was like, you know, really the most important number in real estate is the number of units. It's not anything else. Because let's say you guys, because you guys all have a business, right? Would you rather have 100 qualified business people or clients paying you every month on a contract, or 4 or 2 or 3? You won't have a business relying on that, and you can't go get more if you're looking at just one property. So that's the difference of what I thought. I was like, hey, if I could go move very quickly from owning 50 units, 60 units to buying 100 to 200 units at a time, that is better for me, and that allows me to create wealth for myself, income for myself and my investors. And last but not least, I don't want to continue to beat against the wall and worry about what everybody else is worrying for. I want to lay my head on the ground and on my pillow at night. No, I'm not going to lose my money with an asset that really continues to pay me and that people actually want it. And I have managers and I have great people around me. So that was something that I really wanted to kind of share with you guys. I thought it was important. So ultimately, you know, for me, and I'm going to go through this pretty quick because, like I said, we will be over at 11. I don't know. I just hate long meetings. So, you know, for me, my general target is superior locations in top markets, irreplaceable assets, kind of like the stuff that I'm looking at and I'm showing you that I'm looking at. Buying below replacement costs, like that brand new property. There's a property that just went on the market. It's not even rented yet. They brought it to market in San Diego downtown for $660,000 per door. That's crazy. This brand new property, almost fully occupied, 100 units, still in San Diego County, a few miles away from that. This thing will still trade at under $400,000 a door, right? So that tells me that there's a $200,000 deficit between what a builder has to exit and somebody who's already built something and is partially full in cash flow today. So below replacement costs, near hospitals, Starbucks, Whole Foods, and Sprouts. I'm looking for, hey, I'm just going to use their demographics and their discretionary income based on who they're targeting. It just makes more sense. Near great school shopping, and it needs to have strong, proven market fundamentals, which I believe other people don't because they watch the news. I'm actually boots on the ground, so I'm getting real data. San Diego has strong market foundations, and I believe, honestly, hands down, San Diego will be the next Miami, that everybody's running towards Miami as it relates to cost, because it's almost cost the same. I'll be honest with you, it probably costs the same to live in California as it does in Denver or any other place. David, you probably agree. You're out there in Oregon, and you're probably paying a grip for you probably see people pay an arm and a leg for nothing, and they're happy. But like I said, if you can't get it, you know, it becomes valuable, and that's where we're at. So, you know, I'll go over real fast. So in this particular fund, in Fund 1, it's a $5 million raise. We're almost at $1 million. No, I'm sorry. We're at $1.2 million in that of commitments. So this fund will close out. We're also kind of, you know, testing the water. This is not what I'm here to talk about, but we're testing the water on Fund 2. It's a different fund. Minimum investment on this one is $100,000, but the average investor is actually committed $200,000 to $300,000. That's on the average with a 6% preferred return. Here's how it works. I wasn't going to pull this out, but I want to show you. Can you guys see this? Boom. Your boy's running against time. Man, isn't this fun? I'm sweating if you guys can't see it. That's why I wore a blue shirt.
They put it that way a little bit more because of the window glare.
Gotcha. Which one? Oh, I see what you're talking about.
Other way. There you go.
There you go. Is that perfect?
Yep.
Awesome. Cool. So I wrote $30 million in here because that's the typical price range of the deals that we're looking at. On the average, we're looking at about 70 to 80 units on the average, and anywhere between 70 to 80 units up to about 150. So on the average, we're raising 40% of the equity. That makes sense to me. If we need to raise, if it's less on per deal, that's fine. My value at target is about $400 on a rent raise. Do I think over the next 7 to 10 years, that property current rent will be $400 more? And let's be honest, if you have a property that you get today that's affordable, great location, great swimming pool, great amenities, that's only renting 2 bedrooms for anywhere from $1,800 to $2,000, is it safe to say that in 10 years, the rent in that same property kept up nice will probably range between $2,100 Yeah, you know, at 1,800, 2,100, if they're 2,000 today, they'll probably be 2,400. That's safe. So our cash on cash return to our investors is 6% preferred return, and I'm targeting a 15% internal rate of return. Now, I'm going to be honest, guys. I have to say 15% internal rate of return, but I've always done better than that. Always done better than that. I can share with you those deals when we have more time so you can get a better understanding. But this right here is always the target, just because at any time you do anything investor wise, you have to tell people something. But I can show you track record of mine. And all of our holds are about it's about 7 to 10 years. So if this is an accredited this is an accredited fund only. This is not for non-accredited investors. Some people ask me that I get asked a lot. What's an accredited investor? Am I an accredited investor? It's $1 million net worth. You got to have a $1 million net worth or $200,000 in income last year, and you also got to know you're going to make it again, right? As well as $300,000 combined household income if it's a husband and wife or a partnership, right? You know, there's other ways to do that as it relates to you having a trust and stuff, but I'm keeping it simple for this reason, and I think that's important. And the biggest thing people ask is like, hey, how do we know we're going to exit? All my deals I like to exit when I know we can double or triple our down payment. So like I said, if we had went into a $30 million deal, we put down 40%. So now we're looking at $12 million. At some point, I know on an exit, whether we're going to refinance to exit or we're going to sell to exit or whatever the case may be, if we know we're going to step into that deal and somebody's going to offer us $42 million, depending on the property and depending on how great the location is and what I think is going to be happening, we will exit that deal. It makes more sense to say, hey, if I can double or triple my investors' capital in a relatively short amount of time or an extended period of time because I want a long play, to me, that makes sense. That's what I want. I'm an investor in all of our deals. You know, I believe in the deal. I'm going to close the deal. Like, for example, you know, everyone said not to start the fund first without going to the market and doing this, but I already had investors and I put my own money up personally to get started on this. And I'm going to continue to do that. It's coming out of Victor's pocket as an investor because I believe in what we're doing. So, and I had a lot more to talk about, but I'm not gonna, because I talk fast. Two, I don't want to waste you guys' time because I appreciate your time. I appreciate all of you guys for taking the time. So real fast, and I'm going to unmute everybody if you're not muted. Who has questions that I can answer? I love questions. I'll be honest with you. I really do. So if you have questions, shoot them over to me. I'd appreciate it. Anybody? Come on, Troy. I know you got a question. Tristan? David? Anyone? Am I that good? No, I can't be that good.
You made it crystal clear, bro. You made it crystal clear.
So Vic,
Yes.
as the managing partner here, I'm assuming you have a different equity split than the investors.
Yes.
Can you talk about the ratio between the investors and you?
Yes. So I'm the general partner in this. So I did a 60-40 split. So there's a 60-40 split in fund one. Is that blocking? I'm going to make sure I don't have that glare for you guys. Sorry about that.
Right there.
So there's a 60-40 split. My limited partners are the 60 and I'm the 40. The way we're structuring our fund, our next fund for our Tesla Water Fund, there will be a double structure. So our Class A shares for people coming on board, we'll do an 80-20 split because it'll be a $25 million fund. We'll do an 80-20 split up to half of the raise, and then it goes to 65-35. 65 to the LPs, 35 to the GP. And the 80-20 split on the Class A shares up to it's like 14, was it like 12 and a half or something like that. That'll be 80-20, 80 to the LPs and 20 to me, 20 to my general partnership. So that one is going to be a bigger fund because we're going to have more properties inside of that fund.
And are you expecting to pay out any dividends or cash flow in the interim, or probably not?
Yes, you know what? As a matter of fact, we're looking to do monthly cash flows because typically when we close a deal, I'm thinking within the first 45 to 60 days, we should be able to distribute cash flows to people. And how that's going to work naturally, let's say we close it. All the deals that I'm looking at to close the deals, I'm looking at least a 4% cash on cash return on the entry. right? If we can get 4%, sometimes it'll be like sub 4, like 3.75. And at some point, if we're going in and we start raising rents immediately when we close and we know that that's coming in, that next month we will do distributions no matter what's coming into our investors, because there will be cash flow coming in the door. And then we'll just continue on with that. So first year maybe 4, next year maybe 5, until we get up to 6, because I don't make any money until we hit 6 anyways. So I'm actually working for my piece of that. And then once we hit above 6, then I go 60-40 with the investors.
So the cap rates you're talking about are at 5 or above, or where are we talking?
No, the average cap rate over here is typically about 4.5%. That's the underwriting. Yeah. But the debt that we're looking at is anywhere from 2.75 to 3.25. And naturally, we're coming in with 40% down. Most of the debt market is allowing us to go IL for at least 5 years, interest only, right? So all of the underwriting though is set up for, PI, for principal and interest, because it still needs to debt serve at that level. And you and I have talked, so you understand, from a debt structure from that position.
Are any of the sellers willing to do a second on any of these?
No, not on this type of product. These are great pieces of product. For heavy value add stuff, I'll be honest with you, I'm not seeing a lot of owners even willing to do that. They don't have to. I wouldn't do it. If somebody came to us, we had, a portfolio of 500 or 600 doors here locally, which we will have soon. And somebody was like, "Hey, will you take a second?" I'll be like, "Absolutely not. Go back to market and go raise it."
Yeah.
Capital is easy to get right now. So that those are in the submarkets. When we start looking at Georgias and the Carolinas and stuff and the heavy value adds. But I'll be honest with you, so many of those properties that come on the market, all the people that are cashing out are typically California investors, and there a lot of people over the last 5 years, because capital's been so cheap, people have refied. There's not a lot of value adds there. Not unless you're looking for a heavy lift, but groups are exiting right now because they bought 5 years ago, so the time on their debt is up. So a lot of funds now have to pay back their syndications. They have to pay back their investors. So I'm looking more, not because of there's a problem with the property, but because time's up. The juice has run out, and these guys got to come to market. And some people that they're having a tougher time exiting those deals, and they can't refinance. So they can't refinance and pay out their investors with the promises that they made inside of their syndication. Right. I think that's why some of the lower markets are there. But that to answer your question though, I have not. Matter of fact, I won't even ask. That's not the game. Yeah. This one's a different. This is a different scale, especially with a fund. So now I do have my acquisition company. We'll do that, but those are mom and pops, and every person that sells a house right now that exits with $2 million needs to trade up to something else. So they're all looking at 6s, 8s, 10s, and 20s, and they're just parking their money. So at some point, I'll be honest with you, I don't think prices per door for anything will ever come down again, because we're not buying real estate anymore. We're buying rent, and that rents won't come down. They haven't come down since 1945. They're constantly climbing. Whoever doesn't have a fund over the next 5 years will not be able to buy. And whoever doesn't have an apartment complex to package up and present as a portfolio for the experience and bring in a professional management company to oversee the whole thing, they won't be able to participate either. And I don't know if you're seeing that out there too, David, or anybody else. I know, Bob, you're out there. So these are some of the new things with this new climate that it was always here, but I don't think people had the access to be a part of it. With the Jobs Act coming out 5 years ago, people weren't able to do what they're able to do now. But without the 20-year experience past, it's really tough to be a fund, to even start their real estate fund and be seen as a sponsor, because they don't have the experience to be able to even get the loan, to be able to sponsor. So that's been what I'm seeing.
So what type of, are you talking about a minimum of a 10-year to a 15-year loan generally?
Yes. Yeah. Interest only right now, 5 years is about the stretch, and maybe they'll go 7 depending on the specific deal. But the higher the class of property, the caliber of property, the higher they'll do interest only. But that's why I'm budgeting at 40%. Typically it's 35% down, but I'm recognizing the fact that with the new lending structure that banks want, it's turned into a situation where, you know, they need 12-month reserves, certain amounts of liquidity, CapEx be able to be reserved. You know, we're talking that nicer, newer properties. So the majority of our CapEx is going to be, you know, planting more palm trees, lighting, you know, things like that, making the clubhouse nicer, adding Zoom rooms into the business conference, into the business centers, because that's what's happening. So it's really making adjustments for amenities for nice properties that may not already be there. But typically they are, definitely. But 5-year interest only, but typically the terms have been 10. I've seen 12%. Fannie Mae has a 12% a 12-year product now. And the way that I structured the fund for this fund 1, is a 7 to 10-year hold. But I got the opportunity to extend it if needed, because what I don't want to happen is we have a great piece of property at the end of 10 years and we don't need to sell. And maybe we refinance the property and I've given everyone their initial capital back, but they're still in the deal, right? Because if I refinance a property, give you all your capital back and you stay in the deal, who cares if we hold it for 30 years? It's paying us every month. And now we're just doing a cash on cash return based on equity, right? That's in the property. You know, not the equity, not the capital, because you've already had a capital return. Because we've de-risked the investment at that point. Does that make sense? Can you hear me still?
Yep.
Okay. Did that make sense?
Yeah.
Did I overtalk that like I always do?
Yeah.
Awesome. So anybody else have any questions? Thank you for those questions, man. Those are great questions. I really appreciate them.
Victor, right now you're doing properties primarily in San Diego still, yeah?
Yes, that is our primary market. Yeah.
And you're working with like a bank or a hard money lender as well?
You mean for the funding?
Yeah.
Yeah. Well, you figure for deals like this, you go to the capital market. So it's like JLL, you know, CBRE, things like that. So that, you know, Marcus and Millichap, they have a debt arm. So typically I have people on my team that go to the debt market and they size the loans for the deals that we're looking at. Because they're going to get different, you know, they're working with insurance companies and pension funds and things like that. Very different. So a lot of the local regional banks, they don't go up as high as some of the purchase prices that I would like to look at. Some of them do, but I find it's a lot easier to just go with people who are dealing with size of properties like that, because I'm looking for institutional quality assets. So that way later, when we have a big portfolio, we can roll them up and we can target institutional buyers. So it's easier to look at the, you know, people who deal with institutional buyers because they have better access to the debt. So I do have capital partners that I work with that have a hard money and private lending fund. But be honest with you, it's great if you're kind of a player on the ground. You're trying to make money with real estate. This is an investment. These are investments.
Thank you.
Yeah, for sure. Anybody else have any questions? It is 11:03, and I don't want to let anybody down as it relates to the people taking the time to getting on. So I appreciate that. So any more questions that you guys have, if you're interested in investing with me, feel free to reach out. It takes 5 minutes. I'll load you up. You can set up your account, and then we can go over the documentation. And if you have any questions, that's great. You can do your own research. But I would love to have you a part of what I'm doing on this fund. But I can tell you, if I do something once, I do it 1,000 times. This won't be the end of this thing. I'm going to be doing quite a bit. Yeah, definitely.
So Vic, I got one question for you. If the average door is around 400 or so, and you are buying units around at 100 or so a pop, that to me is like if you're raising your fund at 5M or so, that, and you're trying to put 40% down, I'm not seeing, how does that compute?
Which is why we're doing this. Which is why we're doing the second fund for 25 million. Because what's going to happen is the first fund is probably going to buy about $15 million real estate. Fund 2, which is already in talks right now. Again, it's test the water. It's not up and running. I can't offer it to anybody. It's for educational purposes only. It's 25 million because I recognize with 25 million, we can get about $75 million worth of real estate in that fund. So between the combined funds, we'll have close to about $90 million worth of real estate. And then I'll go ahead and I'll start equity fund 3. And I'm going to probably stick to another $25 million raise on that as I bring in my investor relations team. So that's how. So the first deal, the first fund for 5, that was a mistake on my part because I was like, okay, I needed to get started. And I was like, all right, I'm just going to combine the funds, which I can now. So that way I can have a combined, whatever's remaining from fund 1 will roll right into fund 2, that capital as we're doing the raise. So we can continue on buying property and have multiple properties between the 2 funds together. Does that make sense?
Yeah, so it sounds like Fund 1 is really only going to be able to buy pretty much one property.
Yeah, 1 property. 15 million is the target right now. So that is going to be roughly about 40 doors. So, but fund 2, the $25 million fund, I'm assuming that the first one, because it'll be a little easier because we've already hit our first milestone of 5 million. That's going to buy the next property. That'll probably be between 15 to 20 million. But at some point, I'm going to jump ship. Once I get $20 million and I know that, or I have access to that type of capital because I'm working with private equity funds now, the fund managers, I'm going to jump straight to do a $30 million deal, which is where the $30 million came from. I'm not gonna, there's just less players at that point, and because I would be the only decision maker at that point, as opposed to the other people that are coming to the table, they have fund managers and they got to go back to different people and get permission. I won't. So I think that's going to be our competitive advantage in this marketplace. 1, it's speed, and 2, my optimism about the market. Yeah.
Yeah. Speaking about this market, is any concern with the COVID thing, with this new, lockdowns in a sense being brought up? Is that an issue?
No, I mean, people are going to experience all kinds of different things right now. There's always going to be things you can't account for: hurricanes, what is that called? Earthquakes, things like that, especially in California. You're there. We got the 1 property there. The COVID moratorium has been lifted. The situation we're dealing with the tenant there in Waikiki. So that's there. You do have a lot of people here in California that were dealing with that. But when I'm looking at the properties I'm looking at, I'm talking to the management offices and the owners, or at least the operators, right? Like their connections that they have in their departments. They're not having a lot of problems with people not paying and taking advantage of the COVID stuff because they're qualified tenants. Their income is 3 times the rent. They're paying. They're professionals typically. They're near, all the places and where they're located in their hospitals and things like that. So we have a different tenant mix that weren't really trying to capitalize on not paying rent. They understood the ramifications of not doing that. So again, it just goes right back to what I said earlier. When you're dealing with a different class of property, with a different qualification of tenant, and you take care of your tenants, they understand what they're doing. A lot more responsibility there. So is it a concern? Man, everything's a concern. Using my own phone and driving down the street's a concern. But if I let that stop me from making the investments for my future and for the future of my investors, you're gonna live in a box. You're gonna be
Right.
whatever comes out. Again, so am I putting controls in place based on what's happening? Yes, definitely. Matter of fact, when I'm talking to people and they say they didn't pay, they took advantage of it. I'm like, okay. And here's how I can do that, because I paid my own rent. I rent. We never stopped paying rent. We didn't even consider it. So therefore, I'm more convicted about that situation. I understand some people can't, and those things do happen. But primarily, most of the operators and owners I know of multifamily went to their people. They stayed in communication with them, and they laid it on the table and said, hey, look, this is there, but are you going to pay your rent? We can't seek you now, but we will. And everyone paid for 90. From what I talked to, most of them had over 95% collections during COVID. So, that's a good enough statistic for me to rock forward and not worry about it. And I'm also not dealing with properties that are, like here in San Diego, there's rent control, but I'm not looking for owners who haven't been responsible owners enough to raise the rent. Yeah. So, again, differences. We're dealing with groups and people who have a different level of responsibility of operations because they have responsibilities to their investors. So it's a very different outlook when you're dealing with investment capital versus you're just a real estate guy trying to make money. Right. So that's definitely not the game that we're playing. So, but that's a great question. Thank you for asking that. I really appreciate it. So, any more questions? And I will let us go. So, no, going once, going twice. Boom. I appreciate you guys. Well, look, here's the deal. If you guys want to be a part of this, if you're an accredited investor, you got to be accredited. If you have $100,000 or more, you're interested in investing and or just getting more information, talking to me. I promise you 5 minutes can change your life as it relates to what you're doing. And I will take care of you. I can say that 100%. I will take care of you. I appreciate you guys. I love you guys. If you need anything, feel free to reach out to me. You know my direct cell phone number. If you don't, it's 808-778-1326. Rings right here. And if you guys need anything in the interim, I appreciate your time. Thank you so much. Thank you so much.
Thanks, Vic.
All right. Thank you guys. You have a great day today.
Thank you, Vic.
Take care.